Okay, students, we are going today to solve one comprehensive problem from chapter number 1, which is accounting in the business environment. And in this problem, we are going to discuss almost everything that we have covered so far in chapter number 1. So this is a question from your textbooks. It's from page 1-47. This is the page number that is given to you, and this is the question statement using the accounting equation. We are familiar with the accounting equation is asset is equal to liabilities plus equity. For transaction analysis, preparing financial statements and calculating return on assets. This part, return on assets, we are not going to do this because we will be discussing this in chapter 15. So when we go to the chapter number 15, then we'll talk about return on assets, and therefore there will not be any question in your exams about return on asset. No question in exam 1. However, there will be a question from chapter 15 in exam 4 and the final exam. All right, so we have a Nat, and she recently opened her law office on March 31st. So that's important. And she operating as a corporation. So in this chapter, we discuss various forms of businesses, such as self-proprietorship, partnership, and then specialized LLCs and LLPs, and then corporation. And we discuss this corporation has shareholders. It could be one shareholder or it could be many shareholder. And the name of the new entity, remember the entity we discussed, that a business entity that has a name, that has an address, that pays tax, and that has ownership among the shareholders. Okay, so experience the following events. These events are basically transactions. So these are business transactions or followed during the organizing phase of the new business and its first month of operation. So it's all the transactions are related to March 2024, and the business starts on March 1. Some of the events were personal and didn't affect the law practice. So we talked about it in one of our lecture videos, that the lecture videos that provided to you by the author, that they are personal transactions and they are business transactions. When we're talking about business transaction, we do not include any personal transactions in it. The next thing we going to find out here is what kind of transaction. So this is a list of transactions, or as the question says, events, or events if you want to call it, but the appropriate word would be transactions. Sold personal investment in Amazon stock, which she owned for several years, and receiving $35,000 cash. So is this a personal transaction or is it a business transaction? So at this point, when Annette is selling her Amazon stocks for $35,000, it is a personal transaction. So there is nothing business about this transaction. Second, it deposited $35,000 cash from the sale of Amazon stock in her personal bank account. Also, it is a personal transaction because it has nothing to do with business. Okay. Deposited $73,000 cash in a new business account titled Annette Pacello, attorney, and the business issued common stock to Pacello. So this is a business transaction in which she opened a new business. So the business has a name, the business has an address, the business has a bank account, and she's depositing $73,000 cash into the business. And in return, the business is giving her all the shares in the business. So she is a sole shareholder of the corporation at this very moment. So on March 3rd, she opened a new business, deposited $73,000 cash, and they gave you. Now somebody may ask a question, how many shares? So that information has not been provided in this question. So we do not know how many shares we are talking about. All right. So number 5, paid $700 cash for ink cartridges for the printer. So that will be again considered a business transaction in which the business paid $700 and they receive print cartridges. So $700 is going out of the business and the ink cartridges for the printers are coming in. So cash as an asset is going out and ink cartridges are coming in. They are also an asset because we haven't used them yet. All right. The business purchase computer for the law office, agreeing to pay the account $5,000 within the next 3 months. So the law office, the business, is purchasing a computer for $5,000 and the business is agreed to pay this amount in 3 months. Whether they're going to pay in 3 installments or whether they're going to pay in at the end of the 3rd month, there's promise that so the business is getting a computer, an asset into the business, and the business is giving another business, the computer seller, an accounts payable, a note in writing that I will pay you back this $5,000 in 3 months. Okay. On March 9th, the business received $2,800 cash from customer for services rendered. So this law office provided services to a client, and the client paid $2,800 cash to the business. So the $2,800 cash is coming into the business, and because at some point prior to March 9, the business, this law firm, has provided some services up to a satisfaction of the client, and the client is paying them $2,800. Receive bill, the business is, or the law firm received the bill from the lawyer for magazine subscription, $400. So they are receiving a bill for $400 for magazine subscription. So this law firms may have a subscription of a magazine, and the name of the magazine is The Lawyer, and they have to pay, the law firm has to pay $400 for this subscription. Probably it's a yearly subscription service, and it says use miscellaneous expense account. So they are telling you do not have to create a new account, just use the miscellaneous expense account to do this. On March 23rd, finished court hearings on behalf of a client and submitted the bill for legal services, $10,000 on account. So what they are saying that on March 23rd, this law firm has represented a client in the court of law, and they submitted a legal service bill for the representation they have provided them or provided the client in the court for $10,000. So the law office has did their part of their service, and they are providing, now they are giving the client a bill that the client needs to pay for the services rendered on them in the court of law for $10,000. On March 28th, they paid the bill for the lawyer, means they sent a check for $400 for the lawyer for the magazine subscription. So $400 is going out from the business, and they have going to have secure a subscription for probably the next year. Paid utilities for $1,200. So law office, what kind of utilities? Most likely water, electricity, and internet. And these are the 3 utilities they paid, and they paid $1,200. Now on March 31st, they received $3,300 cash from the clients billed on March 23rd. So the $10,000 they billed on March 23rd, they received $3,300 cash from the clients. All right. And on March 31st, cash dividends of $5,500 were paid to the stockholder. Who is the stockholder? The stockholder in this case is Anat Pacello, and she received a dividend. As you know that shareholders are entitled to receive dividends from the corporation, and in this case they receive a dividend. So these are the transactions that has happened in the month of March 2024. All right, so what is the requirement? The requirement in this case, what we have to do is analyze the effects of the preceding events on the accounting equation of Anat Pacello, attorney. So this is the name of the business, and we have to use the accounting equation to find out what we have to do. Now it says prepare the financial statements. As you know, the financial statements we have talked about is income statement and balance sheet, and then income statement for the month, like we say, and a statement of retained earnings. That's another thing. It's over here, and the balance sheet and a statement of cash flows for the month. We are not going to do this because we will discuss this in a chapter, I believe is chapter number 14, and in this we're going to discuss all the statement of cash flow there. Okay, there are two methods of doing it of cash flow. One is called direct method and the other is called indirect method, and we're only going to use the indirect method for this course. So from now on we will be using these transactions that happened in March 2024, and we will be using these transactions to solve this question. So I am going to provide you all the solution. So let's go to talk about these transactions. So in the first transaction on March 1st 2024, number one, sold personal investment Amazon stock which she owned for several years, receiving $35,000 cash. So as I said, this is a personal transaction, so we are not going to include in our case. In the second one, it says deposited $35,000 from the sale of the Amazon in her personal bank account. So these two transactions will be labeled as personal, we not include. So let's start with, so transaction 1 and 2 are personal transactions and not part of the business. All right, so now we're going to go on transactions number 3 that happened on March 3rd 2024. Okay, in this transaction, as you can see that they have deposited $73,000 cash in a new business bank account titled Anat Pacello Attorney. That's the name of the business, and the business issued a stock to Pacello. So as you are familiar with, the accounting equation is a asset is equal to liabilities plus equity. Okay, so in this transactions, an asset, cash, is coming into the business, so cash is going up, and in return the business has given shares, common stock, for $73,000. So both amounts are up. So cash is up by $73,000. Business received the cash, and the business issued common stock, so the word is issued, to the attorney, and that's how they receive the shares in exchange for $73,000 cash. All right, now we move to March 5, 2024. That's our fourth transaction. It says paid $700 cash for ink cartridge for the printer. All right, so again, asset is equal to liability plus equity. So as we know, cash is an asset. What is an asset? We discussed this in chapter number 1. Asset is something that is going to provide you future benefit. So cash, building, house, factory, equipment, machinery, computers, these are the things that provide future benefit. So in this case, we are giving up $700 cash for ink cartridges. So what we are seeing here, that our cash is going down by $700. So the cash is going down, but another asset, ink cartridge, is going up by $700, and there is no impact on the liability or equity in this equation. All right. Now we are going to move to a transaction on March 7. On March 7, 2024, that is transaction number 5, we are doing purchasing a computer for the law office and agreeing to pay the account $5,000. Is agreeing to pay the account, or the word you're going to see on account, and sometimes you're going to see a word credit. All right, which simply means a business is not paying the cash today. They will pay the cash tomorrow, next week, next month, next year. So in this case, again, we are going to see asset is equal to liability plus equity. All right, so computer is an asset. All right, so asset, a computer is coming in, so it's going up by $5,000, but at the same time you are giving a note or an accounts payable that you will pay this money in this. So I would call, some may call it accounts payable, but I would say note payable is also going up by $5,000. So why this is going up? Because you got the computer, but you haven't paid for the computer yet. You will pay later. So your liability is going up, means for the next 3 months, you are liable to pay this amount in the next 3 months. So here is on March 7, 2024, the business received a computer for $5,000. and they did not pay the cash right away. They will be paying the cash next day or next week or next month of $5,000. So what this it says here, if somebody's read, it's a business owe computer, let's say Best Buy, $5,000. Okay, so this is a admission of liability by the business. All right. Okay, let's move to the next transaction. In the next transaction, which happens on March 9, 2024, on March 9, we receive, the business received $2,800 cash from customers for services rendered. So what we are saying here, that the business has received cash. So again, asset is equal to liabilities plus equity. So cash is coming into the business. So cash is going up by $2,800. And under equity, we have an account called revenue. Revenue is also going up. So why revenue is going up? Because this is a law firm. A law firm is providing a service to the client, and after client received the service, they are paying $2,800 for those services. So that was our transaction number 6. So that was transaction number 6. Now we move to the next transaction. In the next transaction, which happened on March 15, so that would be 1, 2, 3, 4, 5, 6, 7 transactions on March 15, 2024. In this transaction, it says receive bill from the lawyer for magazine subscription for $400. Use the miscellaneous expense account. So what we are saying, we are receiving a bill. When you receive a bill, either you are prepaying or so the bill is they probably have used the service and they now have to pay. So when we go to this account, asset is equal to liability plus equity, what we are saying, we're receiving a bill. So we basically have a accounts payable for $400. Means the law firm owe $400 to this magazine. So as they gave you that it has to be so equity has another account which is expense that we have studied. So the miscellaneous expense is going up by $400. All right. In the next transaction, which happens on March 23rd, 2024, it says finished court hearings on behalf of a client and submitted a bill for legal services of $10,000 on account. So basically the law firm is sending its client a bill for $10,000 for representing. So if we look at, so this is our transaction number 8 happened on March 23rd. So accounting, asset is equal to liabilities plus equity. So what we have here is account receivable. Account receivable simply means the business has a claim on its client or customer. Means the business has provided some services or product to the client, but the client hasn't paid it yet. So this asset is going up by $10,000. Now, why this asset is going up? Because you have provided them some services. So that would be service revenue. In case if you don't remember, there are two kinds of revenue, as a service revenue and a product revenue. So in a service revenue, you're providing services. So law firm, accounting firm, doctor's office, dentist office, architecture office, they are providing you the service. They are not giving you a product, they're giving you a service. So that is their service revenue. So your service revenue up by $10,000. But when you are selling a product such as computer, so that's a product revenue or simply called revenue. Okay, so next we're going to move to our next March 28. We paid the bill for the lawyer for the subscription, $400. So that happened on March 28, 2024. This is our so we are paying. So asset is equal to liability plus equity. So when we are paying, we are using the cash. So in this case, our cash, our asset is going down by $400. And here is an accounts payable, which is a liability, is going down by $400. So here it went up because we owe them this money, and here is going down because after paying off this $400, you do not owe this company any money. All right. So we paid the cash, so cash is down, and accounts payable is also down because we paid the cash. Okay. Now we're going to look to the next transaction. In the next transaction, which is going to be number 10, happens on March 30th, 2024. In this one, you paid utilities for $1,200. So what is happening here? Again, asset is equal to liability plus equity. You are paying using a $1,200 cash. So your cash, $1,200, is going down. But at the same time, your equity account, which is an expense, and in this case, it's a utility expense, is up by $1,200. So this utilities you have already used for $1,200. Once it's used, you have to pay the bill, and then you are paying the bill. Now we're going to go to the next transaction on transaction 11 on March 31st, 2024. In this transaction, one of your client is paying you $3,300 cash. Okay, so in the past, when we made this transaction, we have asset is equal to liability plus equity, and we say account receivable for $10,000, and we said equity is service revenue for $10,000. Now when we receive cash, what we are going to say, asset is equal to liability plus equity. We're going to say we receive cash by $3,300, and this reduces our claim on our client is, so account receivable is down by $3,300. No impact on the liability side and no impact on the equity side. So this, once we have gotten, is there. So now if you look at it, your account receivable was $10,000 when you received it, when you bill the customer. So I would just say when bill the customer, and when customer paid it. Not fully, partially. So he owes us $10,000, but he's paying us $3,300. So the cash for $3,300 is going down, and account receivable is down by $3,300. So basically, this customer still owes us $6,700, but this is how we represent in the transaction. When we make the other information, such as the financial statement, we'll see more detail over there. Okay, now we're going to go for transaction number 12 that happened also on March 31st, 2024. In this transaction, we are paying cash dividends of $5,500 to the stockholder. So who's paying the dividend? The corporation. The corporation that was created in March 3rd, it's paying $5,500 dividends to the only shareholder, Annette. So in this case, we have again going to use asset is equal to liability plus equity. So we're going to say cash is down by $5,500. No impact on the liability, and on the equity side we use a account called dividend, and the dividend account is going up by $5,500. All right. So Annette is receiving as a shareholder $5,500, and the business account is going down by 5. So this money, this cash is going out from the business account, and most likely she is receiving a check. She will be depositing in her personal bank account, but that's not our business. All we know that the business has give up $5,500 to the only shareholder in the name of dividend, $5,500. So now we are done with all the transactions, but we will go over these transactions one more time in a minute. So you may have noticed when we are doing these transactions are always equal. So $70,000, $3,000 cash is going up. So common stock is again going up by 73,000. All right. In the second transaction, the cash is going down by 700, but the cartridges account is going up by 7 because we have received these cartridges. Over here, we purchased a computer. So computer came into the business, which worth $5,000. And at the same time, we are giving note payable to say Best Buy or any other vendor. And we owe them $5,000. And you notice that these two amounts are equal. Yes, in this case, one asset is going down, one asset is going up, and no impact on the liability or equity side. Again, if we look at transaction number 6, here we had the business is receiving $2,800 because the business has provided some services to the client. In this transaction, we are receiving a bill from a law journal, and we owe them $400. This will be our miscellaneous expense. And in March 23rd, we provided client again a service for $10,000, and we are receiving, we have a claim on our customer for $10,000. This claim is called account receivable. All right. On March 28, we paid off $400 for the journal that we have a subscription, and now the claim is going down, the liability is going down, means the journal has no claim on us. Okay. And in the same way, here we have paid $1,200 because we have used utility X for $1,200. And in this transaction, we have $10,000 we billed to our customer because we provided service to our customer for $10,000. Here we're receiving $3,300 from the customer. So our cash is going up and account receivable is going down, and there is no impact on liability and equity. And in the last transaction, the business is paying $5,500 to the only shareholders in the name of dividend, and the shareholder is receiving $500,500 for the dividend. Now we're going to look at the other requirements. So we have completed the first of the transactions. First, so in the part number one, and accounting equation. So preceding events on accounting equation, analyze the effects. So we have analyzed the effects, how these transactions affected the transaction according to accounting equation, asset is equal to liability plus equity. Now what we are going to do next is we have to make an income statement, a statement of retained earning, and the balance sheet. So let's make the income statement first. All right. So to make the income statement, we would be needing these transactions. So we will be using these transactions. So first of all, we're going to make an income statement. So we call income statement. And we usually put the name of the business. So the name of the business is Annette Pacello Attorney. So we're going to say Annette Attorney. And we have to find out, so we're going to start from March 1st, 2024 all the way to March 31st, 2024. So this is our heading for and the first thing that we're going to go is revenue. So how much revenue or service revenue, as they call it, how much revenue or service revenue we have received. So if we look at all our transactions again, we will notice that we have service revenue here on transaction 8 on March 23rd when we provided service for $10,000. So we have a $10,000. That's the one. And sorry, I forgot. We also have on March 6th $2,800. So 10,000 and 28 is $12,800 of revenue here. All right. So this is our revenue, and then we're going to talk about expenses. So what expenses did we have here? So we have a $12,800 of revenue, and we are looking for expenses. So we're going to go through every transaction. So in the first transaction, do we have any expenses? No. Next one we do not have. Next, here we don't have. Here we do not have, and here we do not have. So let's move to the another transaction. So miscellaneous expense. So the first we find is the subscription. So the first one is miscellaneous expense, and that is $400. The next we find is utility expense for $1,200. For $1,200. And do we have any other expense? No. So our total expense is $1,600. All right. So revenue minus expense gives us net income or profit, if you want to. So what would be the net income? So I grab my calculator. I have $12,800, $12,800, and I am subtracting $1,600. So I have a net profit of 11, or net income of 11,200. So that is my income statement. All right. So if you look at the income statement for Annette Pacello attorney from 3/1/2024 to 3/31st 2024, in which we have a service revenue of 12,800, which came from 2,800 plus the $10,000. Okay, so so this is our total revenue. These are our miscellaneous expense. This is for magazine subscription, and this one is for utility expense. The total is $1,600. When we subtract, we have a net income of $11,200. All right, so the next thing we're going to do is we're going to make a balance sheet. So when we're going to make a balance sheet, we're going to say balance sheet, and we are going to say Annette. I hope I'm not making a mistake in writing the name. So it's Annette Pacello attorney, and this one is as of 3/31st 2024. And when we make the balance sheet, the first thing we put is our assets. So assets, the first asset that goes is called cash. So now we have to figure out how much cash we have. So we will go to our transactions to get this information. So if you notice, we have a cash that we received is 73,000. So I have received positive $73,000 cash, and then I paid $700 for ink cartridge. Now I purchased a computer, but I did not pay any cash, and we have accounts payable, so this one is not going to count. So let's move to the next transaction. Here we received $2,800 cash, so we're going to say $2,800, and then here we send a bill. We didn't receive the cash here, so we do not know. And in number 9, we pay $400 for magazine subscription, so that counts. And then we pay $1,200 for the utility, and then we received $3,300. So $3,300. So I'm going to grab a calculator again, and in this calculator I am going to add 73,000 plus 2,800 plus 3,300. So this is the cash we have received, $79,100. How much cash we have paid? We paid $700. Then we paid $400. Then we paid $1,200. How much cash we have? At the end of the month, we are sitting on, we missed one more thing. We paid the cash for $5,500. So we subtract the $5,500 dividend that we paid, and we have a total cash of $71,300. So this is how I calculated my cash. I received $73,000 when the business was open. We received $2,800 from the customer. We received another customer $3,300, and we paid $700 for ink cartridge, $400 for magazine, $1,200 for utilities, and $5,500 for the dividend. So now we have a total cash of $71,300. Now, what other assets do we have in this case? So let's go back to the first transaction. In the first transaction, we have ink cartridge. We do not know. We still have these ink cartridge, whether they have been used or not. So this will again $700 of ink cartridge. Okay, now let's see what else we have. We have computer for $5,000. So we have a computer for $5,000. All right, let's see if we have any other asset. We have an asset of account receivable. Now account receivable, we send a bill originally for $10,000 and the customer paid us back $3,300. So that means the customer is still owe us $6,700. Account receivable usually go right after the cash, so I will just excuse them over here for $6,700. So do we have any other asset? No, we don't have any other asset. So we're going to add all these assets. So we have a cash for $1,300 plus $6,700 for the AR or account receivable, plus $700 for the cartridges and $5,000 for the computer. So we have a total of $83,700. So $83,700 is the total asset we have at this moment. All right, now we're going to go to the next thing. It's called liabilities. So what liabilities do we have? Okay, let's go back from the very beginning. We don't have any liability here in this transaction. We don't have any liability here. We don't have any liability here. We don't have any liability here. Now we have a liability of note payable of $5,000. So we are going to put in our liabilities notes payable of $5,000. All right. Now we're going to look for another liability. So we go to the next page. We don't have any liability in this transaction. We don't have any liability here, but we do have accounts payable for $400. But you notice we already paid off this $400, so we do not have. So this liability cancel out because we pay for this transaction. Now we go to number 10. We do not have any liability here. No liability in this transaction. No liability in this transaction. No. So our total liabilities turns out to be $5,000. So total liabilities of $5,000. All right. Now we're going to look for equity. All right. Equity, we have to go back to the first transaction. So if you notice, we have issued common stock for $73,000. So this part is going into equity, common stock, $73,000. So that's one. Then we don't see any equity in this transaction. We don't see any equity in this transaction, nor here, nor over here. Now we go to, we have a revenue of $2,800 and we have an expense of $400, which we have already used in income statement. Service revenue, equity, we do not have anything over here. Now we go here, utility expense we have already used, service revenue has already been used. Now we have a dividend. So dividend we paid for $5,500. So dividend is $5,500. So dividend is a account, so that reduces the shareholders' equity in it. So that's the dividend that we pay to the shareholder for $5,500. So the total equity turns out to be at this point. I would like to stop here and I want to share something with you. First of all, when we are doing making a balance sheet, before making a balance sheet and after making a income statement, we should make a statement of retained earning. And the reason is because a statement of retained earning, the ending balance of the retained earning are goes over here. And this dividend is used in a statement of retained earning. I'm going to show you how. So let me show you a statement of retained earning to you. A statement of retained earnings for Annette Pacello, attorney. Okay, as of March 31st, 2024. So a statement retained earning, the first thing is the beginning balance of retained earning. Now, as you know, this business start just on March 3rd, so the beginning balance will be 0. All right, and then we add net income. So how much net income we have calculated? We have calculated a net income of $11,200. So $11,200. And then we subtract net loss, but since we do not, it's always either or. Either you're going to have a net income or you're going to have a net loss. So if you have a net income, you will add it. If you have a net loss, we're going to subtract. Since we do not have a net loss, so I'm just scratching it out. The next thing you have to subtract is the dividend. So the dividend we paid was $5,500. So that gives us the ending balance of retained earnings. Earning as of March 31st, 2024. So we take this bracket means it's a negative number. So we start with 0. We add 11,200 and we subtract 5,500. So we have a retained earning of $5,700. All right. And then we will take this and we'll go our retained earning over here and we add $5,700. So that will give us total equity. So now total equity is going to be 73,000 plus 5,700. That will give us 78,700. So we have $78,700. Now, this is our balance sheet. So I'm just gonna take this much place from here. As we know, the balance sheet equation is asset is equal to liabilities plus equity. So what is our asset? $83,700. How much liability we have is 5,000. How much equity we have is 78,700. So if we add these two numbers, so 78,700 plus 5,000, we get 83,700. So our equation, whether it's a one transaction or whether it's a both transactions, for the entire balance sheet, these transactions should always be equal every time for asset is equal to liability plus equity. So this is our chapter number first. If you have any question, please let me know. I'm going to scan these paper and post it for your reading. I hope you can watch this video. You can should be able to watch this video as many times as possible. Thank you.